Center.
And as Patrick has correctly told us, bankers, today marks 14 days since the Banking Amendment Bill was signed into law, effectively capping interest rates at 4% above the central bank rate, that's CBR. Now, a number of banks have openly complied, but arguments for and against capping still remain, as market analysts worry about the impact this will have not just on banks, but on the economy as a whole. Of course, we saw a dip in banking shares immediately after the signing, a clear sign that the markets were skittish. There are concerns about the regional context as well, given the footprint of some of Kenya's biggest banks, as well as the possibility of many losing their jobs. So what is the way forward? I've got with me in studio the Group CEO of Kenya Commercial Bank, Joshua Igara, as well as John Gashora, the Group CEO of NIC Bank. Gentlemen, thank you so much for making time to be on the Business Center today. Let's just start off from the top. Now, Kenyan banks have been enjoying interest rate spreads of an average of 11.4%, while the world average is actually 6.6%. Before we get into the cracks of the issue, what informed these spreads in the past?
Well, Tarian, thanks for having us tonight. I must say, first of all, we are very supportive of this law, and I think the announcements that the banks have come out with in the last, since the law was signed, actually, I think shows a commitment to make sure we make peace with our customers, if I may use such words. So I think the notion that banks would be against getting customers that are financially stable would be unfortunate. To the question about the high spreads, there has been a number of reasons, and I think before we even answer that question, I think it's worth noting that rates actually have come down over time for a good period of time. People forget in the 1992, 1993, when rates were even 50%. The rates have come down over time. Just 2011, we saw rates again jump up quite significant, and they were coming down. And even this year, after the rates jumped up last year in November, you've seen rates actually continuously come down. So I think overall, I just want to make the point that banks have been working as part of the wider economy to make sure that rates do come down. So, but the high spread that we have seen has been for a number of reasons. One, and we have talked about this before, we don't have a true clear way of judging the credit risk in the system, which is why working with the government, working with the central bank, we came up with the Credit Reference Bureau. But that framework of a Credit Reference Bureau takes time to mature. And I think we have been doing everything we can to provide the information to the Credit Reference Bureaus to make sure that information that is built into a database that over time can be used to be able to differentiate the different risks that we face in lending.
All right, and of course, I'm sure we'll get into the credit referencing issue in just a moment, but allow me to say that I don't think the 50% that was there in terms of interest rates in the years that have gone by is justification for the interest rates that we have seen recently. However, Igara, why are the banks suddenly happy to support this particular law?
Terry, and thank you for having us here. And I would say that banks have always supported a reduction of the rates. I mean, I don't think that the industry has always been, if you look at all our communication, I think we've been saying it is maybe the pace or how it is being addressed. We've been working since 2013 on the Cost of Credit Committee, reducing an access of credit. You remember a stakeholders event which was chaired by the Cabinet Secretary, still is chaired by the Cabinet Secretary of National Treasury. So now that the law has been passed, I think the question is how do you accelerate lower interest rates in the market? And therefore banks are much able to support the initiative that the President has signed. I would say that the work still continues. The President was very clear that there's still work to be done in terms of putting process and policy to make it easier for increased access and lower rates. And Terian, if you look at our own spreads in the industry, around about the spreads of 7–8%, that's comparable where we see markets, in West Africa and South Africa. So you're talking about 11%. For me, the question is how fast are we going to get there? And I think this is one way of accelerating the achievement of lower spreads in the industry.
All right. What then does this portend, for the banking sector? And I spoke to somebody who said for the Kenyan banks to at least sustain profitable growth, they need a margin of at least 6%. I don't know what your thoughts are about that.
Well, what this portends is, well, first of all, we must accept there's a new normal for banking. I think, you know, with the announcement out there, I think it clearly shows that we have accepted this is a new normal. And I think what it means for all of us is that we have to look at our business models. We have to look at the expense lines. We must continue investing in the economy, and to do so, we must make sure that we reduce our own costs to be able to continue making those investments. So I think what you see, what this portends is there's more innovation. I know banks are quite innovative, will continue to be innovative. Two, I think it's a commitment that we'll continue to support the economy.
What does this mean about operating costs? And it's interesting you've talked about the structure and the new normal that banks will have to adopt to now, given the fact that we are in a market where smaller loan sizes always impact the types of operating costs that we are seeing across the board. What then does that mean?
Terry, one of the issues that I want to agree with John earlier is that this is going to push a little bit more competition in the industry. So at the end of the day, the beneficiary for me is going to be the customers today that are able to access the facilities and the credit that they require. So banks will have to look at their own operating model. How do we operate in this kind of market? And it's not going to be the same business as before. So we may see auction of credit, for instance, in the industry, where you're going to bid for the best kind of value that you get. So great customer credit scores will get better rates. So although we are talking about 14.5, you will see customers getting as low as 7-8%. I can guarantee you. You will find there are customers already borrowing at 10 or 9%, even in the previous dispensation. So we like to see that happening. We'll also like you to see in the last few, a number of banks already started applying the new regulations from beginning of September. And what we've seen in the market is more customers coming in for more facilities. Customers are already pre-qualified saying, I want to do a top-up. I want to use my reduction in my loan repayment to get a higher facility for something else. So you may unleash new opportunities for customers in this particular moment. So the 14.5 is not just the only rate available in the market. It's actually, although the limit is smaller, I think customers should actually be able to demand for finer rates from the banks.
There is a fear that people might lose their jobs. In a recent interview, the KBA CEO, Mr. Olaka, refused to actually rule out the possibility of mass layoffs. And I'm just curious about that. Are people going to lose their jobs?
Look, I think there's no question that efficiencies have to come into play, right? When you have such reduced margins, most likely one of the reactions in terms of innovation would be to make sure you're a bit more efficient, perhaps use more technology, and that sometimes could mean a reduction in force. My belief is this, that as Joshua has said, hopefully this will bring more customers to the banks. More customers will be willing to not just borrow, but also to save. I mean, we're introducing such wonderful saving rates, and Kenya is a country that we need to push rating as a drive. And if that happens, then I don't see the reason why there should be layoffs. But I think efficiencies will certainly be a key theme for banks going forward. You've
talked about wonderful saving rates, and I want to look at the flip side on mobile money banking. Where do you stand currently, and where is the industry at the moment? Because there's still a lot of banks trying to hold on to this so that they can still get some higher interest rates, which are between, honestly, 60 to 100% if we look at it at an annual basis. But because we're taking it on a monthly, M-Shwari or equity mobile platform, then we look at it from 6%, I think, to up to 7.5%. But it is way beyond anything that it should be. Where do you stand?
Sorry, I haven't seen, I think you made the comment earlier that banks are still fighting the new law. I'm not sure that's actually correct. Even after the president had ascended the bill, banks already agreed early enough. From beginning, actually last week of August. So banks are complying. I'm not sure that any bank today is saying that they will not comply. Ourselves, for instance, whether it's a mobile product, what we are saying is moving those products into the new regime where the higher rate is 14.5%. That will apply to all the products that are available in the market today. The same thing will apply to deposits. So if you have an interest-earning account today, the minimum we're going to pay that is 7.35% at the moment. And then you still can be able to negotiate with your bank based on what you actually have on the table. So you have also call accounts, you've got savings accounts as well. And then there are customers who still run their own current accounts, which are what you call transaction accounts, which are operations. And that traditionally has not been able to pay interest. So I would say that the direction from what I see from industry and also from what the KBA has mentioned is banks are complying. I mean, so we don't see the contradiction today that banks are saying no. I'm not aware of any institution today that is saying there may be clarification that will come in the days ahead. So few issues that are being, like for us, we've engaged our customers to say, okay, we need to revise our letters of offer, we need to be able to engage and give you a new form of offer. But we've already applied the rates. Now it is more the process to be able to be resolved, and that should be finalized most likely in the next few days.
Let's talk about negotiation, which Oigara has alluded to just now. Where does this leave credit referencing bureaus? I mean, in the past there's been a lot of complaints that the banking sector as a whole has really not paid attention, and regular borrowers have not had the muscle to take their credit score and get a better rate out of this. Is this a lost opportunity for now?
No, absolutely not. I think what Joshua said is that actually 14.5% today is the cap. It doesn't mean that everybody walking through the door will borrow at 14.5. There are individuals who can afford to get better rates. Now, for that reason, therefore, we need to be able to differentiate people's credit ratings. Therefore, in my view, the Credit Reference Bureau framework must continue to evolve, and we must support it fully, because down the line, I want my customers to be able to walk in and say, based on my credit rating, 14.5 is too high for me. I want 10.5.
All right.
So we must continue to build that framework.
Maybe it's also two-way. One of the appeal that we like to make, as financial institutions, is for customers also to follow through their credit score. Last year, the amount of credit reports which were looked for was more than about 2 to 3 million. Now, there are more than 20 million able borrowers in the market. So it's also two-way. The banks now will need to see more innovations where you say, this is where I see, if you get a score of 100 points or 900 points, you can actually be able to push for a better kind of access of credit from your bank. So it's an opportunity for customers to use that information. Some of them is available. We have 3 reference bureaus available. So I like to see that push even from our own customers and from banks. And I will agree with you that we haven't been as aggressive enough. We've used it naturally to penalize the customers from borrowing.
Exactly.
We like to use it much more positively to reinforce customers who are good to get a better rate of credit.
So where does this leave the Kenya Bank reference rate? Is it as good as done?
No, it's not actually, because the regulation that says that we should use the Kenya Bankers reference rate as a reference rate, that is still in place. So in fact, the banks that are saying rates are now up to 14.5, what they'll tell their customers is still KBRR plus X, which is below 14.5. So that continues to be in place. Obviously, I think the central bank has been, and the Kenya Bank Association have said that they are working to review the calculation of KBRR. And I think that process is still continuing.
All right. Last week there were stories about several thousands of Kenyans being referred to credit bureaus over the littlest and the tiniest of balances. Is this something that you experienced?
I mean, you're right, Terian. I mean, if you look at the credit information sharing, and whether you have 10 shillings or 50 shillings or 1 million shillings, I think the credit portfolio assesses how prompt are you in terms of paying. Remember, Terian, on the mobile loans, for instance, we lend as low as 50 shillings. So if I borrowed 50 shillings, that is 100% of my loan. If I'm unable to pay the 50 shillings, then I will be able to report that information to the Credit Reference Bureau. It's not how little the amount is. It's whether I met my commitment to pay on time. And look, what we'll ask for, and what we're working very closely with the Central Bank and the National Treasury, is to expand the credit information. So today, you can talk about your own utility bills, your own mobile payments, your own shopping, your own grocery stores. How do you build? If you get a whole credit file, we'll be able to move away as an industry from, for instance, the securities we ask for. Many markets have moved away from security lending to credit scoring. So I would say that the small amount shouldn't disadvantage. Small amount again may be 100% of the loan facility for our customer, which is the difficulty in the industry to manage.
And I think just to add to that point, I think Joshua made this point, that it's important for borrowers to ensure they are checking to see what their credit rating is. It's not just banks to know what somebody's credit rating is. People must be informed of their own credit rating and make sure that they challenge some of the information. That some of it has been erroneous. I must agree, banks have made mistakes in providing some of that information. And until customers go and find out that some erroneous information was entered, there's no way we can continue to correct for them.
We're coming to an end, but I quickly need to ask an issue that a lot of Kenyans worry about, and this is bank account portability. For instance, Bank A, reduced based on CBR. Unfortunately, that was changed again today, from what I understand. But if I wanted to move my loan from one bank to another, the paperwork is still, quite a difficult thing. Why is it so hard for that to happen, Joshua?
So Terry, and there are two ways, and remember, we have also agreed, for instance, that there were charges that we are levying on customers on account closure, and banks already announced that has already been zeroized from beginning of September. But let me just give two aspects on how we see lending. So in the last few weeks, we've been looking at customers refinancing naturally. So this is someone who is as a business, he's an SME, he's kind of a salaried employee, or just any other customer. Actually, Tyrian, to be able to refinance your loan from another bank could happen today either on your mobile platform, could happen directly with your branch. And we are seeing a question of loans being approved within minutes. And because most of the loans are unsecured today, there is really no documentation required, Tyrian. The secure documents are much more the SMEs which are charged, or the larger corporates which are charged. And that's the process that banks are working very closely. We've initiated a security arrangement mechanism where banks can be cleared. And generally, if there is an issue, that banks need to respond. But for majority of customers, if I walk in, let's say, from NIC tomorrow, or from KCB, you should get your loan approved before you leave the bank. That is the guarantee we give our customers.
I think, Tayan, for the loans that perhaps you've heard complaints about, the ones that are secured, the cost to transfer a loan are not actually to the bank. It's usually to the lawyers, to the lands office. It's usually to the external parties. The bank that we're transferring from actually doesn't charge a cent. And by law, we cannot charge what's called prepayment cost. If you prepay your loan, we cannot charge you a fee for that. So really, the cost to transfer a loan, as far as the bank is concerned, is nothing, is zero. Except for the fact that if you're transferring security, there are the external costs to do with lawyers, to do with government offices that come into play.
As we quickly wind up, bank shares were absolutely hammered, this month. But we've begun to see a shift. Biggest movers today, KCB, Equity Bank as well. We saw some upticks with Standard Chartered ending up on the green, and it was also among the day's top gainers. Is it the time to buy, Joshua, as we wind up?
So, Tyrian, let me say that the market has responded because of the lack of clarity, and we've been engaging our investors locally and actually internationally. What I see now is that there's more clarity coming into what this will mean for the sector. What does it mean for the whole economy? And banking is not just about the sector itself. Banking has a huge impact in a lot of activities in different sectors. So where we are today, banks are trading at huge discounts, Tyrian. And if you think about the medium to long term, which is more about 2 to 3 years, if you take that window, banks are still going to be fundamental players in the growth of our economy. So I would say, banks like us who are trading today at 50% discount today, there's great opportunity. There is, on the fundamental side, the assets are there. Yeah, the business network is there. The ability to deliver earnings is actually there. So I would say, with more information which you are now clarifying, I believe we should see response. I kind of believe that we've seen a kind of a lower hit on our shares today, and we're looking for an upside. All right, thank you so much. We have to end it there. Thank you so much for making time to be on the Business Center tonight. John Gashora, the Group CEO of NIC Bank, and Joshua Oigara, the Group CEO of KCB Group. Thank you so much for being on the show tonight. I'll hand over to Michael Jenga for the rest of the business news.